Silver has not done so. We're arguing its time is now, and it is likely to do it very rapidly in a way that just jolts people. So if you're not already there, don't come back in 6 months. Okay, it's not the time to be joining. You're going into a new price reality, and I think likely fiat currencies will be questioned by large governments in this next debt crisis, to where already some major governments around the world are pondering seriously moving to gold-backed currencies. We know that. And the Western world, and Japan included, could be the laggards in suddenly realizing, hey, this 100-year game hasn't been working. We need to get something more stable. But you got to go through a crisis sometimes to create that change in thought. And I think gold and silver know that's coming. Even just to go back to the high in 2011, which was about 3.5 there.
Okay, right here. Yeah,
that's enormous.
That is
even
enormous.
If gold just sat still and silver went to 3.5%, it would go off the page. We're arguing now. There's another set of charts that sort of smack you in the face and make the point. It's the base metal charts I sent you. Well, you could stay on this chart for a minute.
Okay.
But draw a line at 2%. Drop your line down to 2. Look how many times it's been at 2%. It's hardly abnormal.
Oh, yeah.
Yeah, it's no big deal.
That's kind of the average.
And you could already see the spread since 2000. There's like a downtrend, too, on that spread at the last couple of years.
Yeah.
And you're starting to approach that. So you could easily go to 2% just as, hey, big deal.
Yeah.
Well, that's off the page, even at current prices, in terms of where is silver price versus gold. And if we're in a bull trend, so if we match the bull trends, we could go to 3+.
Yeah.
And you did it quickly. You didn't do it in an arm wrestling manner. You did it in a thunderbolt.
Yeah. Yeah. These are parabolic, violent moves that happen in 6 months and they're over.
Not only in the spread, but in the price of silver as well. So, yeah, and this is not unusual, by the way. Silver has made a grand mistake. That's what we're arguing. Markets make errors. Anybody who's been in markets long enough knows that, hey, that .com top, that was an error. It went too far, too long, and therefore it broke. NASDAQ dropped 82% in the next 2 years. 82% after that bubble broke. Because it was why? Nothing wrong with the truth of the internet. It changed our lives.
Turning our attention to base metals, the spread between copper and its brethren and their long-term averages shows a narrowing trend. A line drawn at 2% long, a resting point, has become a threshold once again. Since the 2000s, the spread has drifted downward, making any movement above that line look anomalous. If silver were to mimic such behavior, the leap could be swift. The narrative here is clear. When markets correct distortions, prices and spreads don't gently creep, they thunderbolt.
But they overpriced it too quick and it burst, okay? Now, ultimately, it proved itself, but it went down 82%. Okay, the same thing happens at lows sometimes. Sometimes a market will go low, abnormally low, irrationally low, and stay there, and everybody says, see, what a dog, I'm not interested in that market, just leave it alone, don't step on it, and when it wakes up in a way that is like a sudden jolt. Like, what am I doing down here? Flip to those charts, if you would, of the copper and lead, I think what it was.
Okay.
They make the point. So it's a reality that people
Here's
need
copper,
to realize.
And this is going back to the early 90s until present.
Yeah, you can, in fact, take that lower range you see in the 90s up to 2000. It goes back into the 80s as well. This is a Federal Reserve chart of the price of copper, by the way.
Okay.
From St. Louis Fed. I guess monthly closes or something. But anyway, you lived in a range, okay, for decades. In fact, it goes back to the 1980s. But look what happened when you came out of the range.
Yeah.
You tripled. You went from 3 to 8 to almost 9,000. You've almost tripled in price. But the first doubling was a matter of a handful of months.
Yeah.
And this, by the way, was not correlated to gold and silver at that time. They had their massive move later on in that trend. Okay, so the copper did it on its own. And then look what happened after that. Yeah, you had a big drop, but look, you live in a new range now.
Yeah, this is
now
the new
suddenly
home.
It's a range that if you take the middle of that, about 7,500, That's still double and a half what it lived in between the 1980s and 2004. A new
Yep.
reality is what I'm saying. And it did it quickly.
Consider copper. For decades, from the 1980s through the 90s, it traded within a broad static range. Then suddenly it exploded from around 3,000 to nearly 9,000 in short order. That first doubling happened very rapidly. Interestingly, this did not happen in lockstep with gold or silver. Copper carved its own path. The lesson: once a market shifts regime, the prior normal simply evaporates. Today, copper is pushing beyond its earlier peaks, and the question becomes, are we entering the next era of elevated norms?
Yeah.
Right now, by the way, copper's trying to break out of that thing again. And by the way, copper right now is trading well above its 2011 price high. It's not real clear on this chart, but when you look at a monthly futures, you can see it's above it. Drop down to the next chart, a very exciting market called lead. Again, you could go back to the 1980s and you lived in this dull up-down range, just like silver's been in for 50 years. And that was its reality. And then when you came out of that reality, see the red ellipse? You went from 1,200 to 3,600 in a handful of months. And by the way, this is not coincident with that copper move. This is a year later. So it wasn't at the same time. So it was peculiar to lead. But it went into a new reality. Oh, yeah, it had a sharp sell-off after that. That's not the issue. The issue is, but look at the new reality that prevailed since then. Double to triple the price of the old reality.
Yeah.
If silver did this, you could go like the $200+ and then level off into a new reality that's, just say, 100 to 250 or something.
Yeah.
Okay.
Yeah.
So what we're arguing in answer to his question, there are so many fundamentals out there that are huge involving the failure of fiat currencies in terms of distorting reality, creating monetary inflation, and therefore price inflation of assets like lead price. I could have shown you a bread price chart or a beef price chart. Look the same as this. A new reality. All distorted by the money unit that you showed, the M2 chart. Silver has not done so. We're arguing its time is now, and it is likely to do it very rapidly in a way that just jolts people. So if you're not already there, don't come back in 6 months. Okay. It's not the time to be joining. You were going into a new price reality, and I think likely fiat currencies will be questioned by large governments in this next debt crisis, to where are already some major governments around the world are pondering seriously moving to gold-backed currencies. We know that. And the Western world, and Japan included, could be the laggards in suddenly realizing, hey, this 100-year game hasn't been working. We need to get something more stable. But you got to go through a crisis sometimes to create that change in thought. And I think gold and silver know that's coming.
Lead may get less media attention, but its chart tells a similar tale. After decades in a humdrum trading band, the price vaulted from around 1,200 to 3,600 in months, again not coincident with the copper move. After the sell-off, it settled into a new higher trading range, double or more of the old reality. If silver were to follow, one could envision lofty levels, e.g. $100 to $250 in the new paradigm. The point: markets don't just rebound, they redefine their baseline.
Its long-term correlations are with the Bloomberg Commodity Index. It moves like a commodity. If you'll look at what happened to platinum over the last few years, while gold, we'll go back to 2015, for example, on that chart, right about there, it was about, what do you got, $900 or something there in 2015.
2015
Yeah, right. Okay.
is
Yeah,
right around here.
right there. Just stop there. Okay.
Okay.
Gold has doubled in a half since then. Is platinum linked to gold? No, of course not. Okay,
Good
no.
point.
The Bloomberg Commodity Index has also been going down from 2015 through 2020. Now, platinum made lower lows here recently, but Bloomberg didn't. But platinum moves in waves, more like the Bloomberg Commodity Index, meaning grouped with like wheat, base metals, energy prices. They all tend to move together with the Bloomberg Commodity Index as a category. Sometimes that category, and it's rare, late 70s is one example. Uh, 2007 to 8 was another example. Gold was going up, but then the commodities peaked at 8 and went down despite gold continuing up. So there was no correlation there. And you see platinum did not continue up through 2011. By 2011, it had already collapsed while gold continued up. So it's not a good correlation. And yeah, you might get a rebound here in the ratio, but don't think it is a monetary metal. We never use the word precious metals with gold and silver at MSA. They're monetary metals, and it's a distinct difference. Palladium and platinum are precious metals, but they move like the commodity category.
There are profound structural forces in motion: fiat currency strain, inflation of money supply, and asset price distortion. The new price realities in metals like lead mirror inflationary effects of monetary policy. Bread, beef, base metals, many are telling the same story. Silver hasn't yet moved dramatically, but many argue its time is now. Governments are wrestling with debt, and some even peer at gold-backed currency ideas. When faith in the unit of account wobbles, the monetary metals step into the spotlight.
Recently, our annual momentum of palladium, platinum and palladium has said, okay, back into positive mode. But that doesn't mean they're rivaling gold. It just means they're back into a positive trend. Definitely lagged to gold, not just in discounted to price, but in the trend direction. They've not been in sync with gold since a long time. So don't try to treat it as a sister metal of gold.
Okay.
Yes, it's in a bull trend now. We think it's turning up and it's valid and it'll go higher. But, and maybe it goes up at the bottom end of that range there. I don't know. That's not really the issue because it is not a money unit.
Okay. Okay. Yeah, I've been thinking of this one in the form of ratios, but you're kind of saying that you're kind of comparing apples and oranges because gold is money and platinum's more of an industrial metal.
You could show a corn chart and say the same thing.
Okay.
Is corn get back to its regular value to go? Well, yeah, corn could go up when the commodity index turns up, and it's on the edge of that right now. Bloomberg is about a point below a major breakout level for us. It's not there, so we're not counting it yet. And by the way, breakout, I mean a secondary move up because we had a big move between 2020 and 2022. And then when that war began, commodities peaked and went down. By the way, the war did not cause the commodity rally. But I think that Bloomberg is ready to perhaps coattail gold. This is what happened in the late 70s. Gold made a low in 76 and turned up and went through 1980. In 77, a year after gold had made its low and turned up.
Let's conclude with the what next and why it matters. While gold may continue its path, commodities broadly are not dying assets. They're cheap relative to previous peaks. The Bloomberg Commodity Index today sits well below its 2008 highs. Historically, commodities lagged gold and then caught up, often during or after economic stress. So if inflation ticks up, fiat falters, or markets rotate out of stocks, the metals complex, including silver, could erupt fast. If you're not positioned now, you might miss the initial jolt.
The Bloomberg Commodity Index, or the CRB back then, lagged to gold and turned up also. And finally joined it. But it wasn't in sync. It was lagged to gold. So we could have a situation where, stock markets, especially the bloated ones, go down, economy turns negative, and commodities decide to join gold. Don't expect commodities to weaken if the economy weakens. There are plenty of examples, 2007 and 8, for example, where they were booming and stocks were topping, or 2000, 2002, or late 70s to 1980, we had a global economic recession, and yet commodities boomed on the coattail of gold. So they technically look like when the asset class shifts out of stocks, that's a lot of money, and goes to a new place, they're also going to find out that commodities are dirt cheap relative to like 2008 or 2011 prices. Bloomberg right now is 105. You know where it was in 2008? 270.
Okay.
No, 238, I think it was. So it's less than half the price that Bloomberg was in 2007-8.
Yeah.
Okay, so it's not expensive, and it's clearly stabilized.
Yeah.
And after that zoom from the 2020 low where it said, I'm out of here. Okay, that was leg one. I think leg two could start soon.
Okay.
And therefore, things like platinum, which is now in a leadership position within the commodity complex, it's much stronger than Bloomberg, for example, lately. But that complex could turn up and investors could say, hey, that seems to be working. Let's buy some stocks that mine platinum, mine copper, mine lead, or produce fertilizer.